So let's get this started. I'm gonna just share my screen real quick before we bring Mary on. Those of you that are here for the first time, we do host networking events, in-person networking events in the LA area, specifically in Pasadena and the Studio City area. We have a webinar around creative real estate strategies for wealth for, mainly for those that, are struggling, whether you're an investor or a realtor, you're struggling with your business or you don't know how to get your business started. I would love for you to join myself and Coach Monica Kay. Mary's joining us today. She's going to be sharing a wealth of knowledge around, financing, creative ways of financing and so forth. But, the way Mary and I met are in these events, right? And, our business and business in general is really all about networking, building relationships, and creating trust, right? So, and it truly works. So it really, really works. If you want to do something impactful for your business, I would personally recommend attend networking events, whatever networking event fits the niche of business that you're in. Mary, correct me if I'm wrong. I know you've done a lot of business coming to events,
Absolutely,
right?
yes. It's a very good strategy and way to actually establish relationship, go one-on-one with people, explain to them, and really build this network for you and for them at the same time. Because
Yeah.
you can educate one-on-one and really opens the door for a lot of opportunities.
And I hear, specifically, I hear from others specifically about you and some of the other guests that attend our events. I mean, thank you for, being consistent, right? That's what it really is all about, is consistent. You're there, I would say, almost every single time we have an event. And I know that those are my events that I know of. I know you attend others, and I hear from others that they've done business with you and they're very happy, they're satisfied, and that's, obviously that's what it's truly about, is for, professionals like yourself to do business, but also it makes me a lot more happier when I know you took care of the client, they come back with good feedback, and then, they share that with others, and, you grow your business, and we grow the community with awesome people. So I want to thank you personally for that, Mary, and, any of you that have been attending our events. Thank you for taking the time to be there. So just a little bit about me real quick. My name is Alex Nahle. I'm a real estate investor. I focus on fix and flips and the BRRRR strategy in the LA area. I do invest out of state. However, I'm bullish on the LA area. If you're not familiar with what the BRRRR strategy is, it stands for buy, rehab, rent, refinance, repeat. Some of the rentals that we're working on now are the co-living model, which is rental by the room. So we're super excited about that. It is a new model that we're implementing in our portfolio. It is something that I truly believe it's going to be huge, similar to how Airbnb when it first started. And I'm excited to share that, about a little bit over an hour ago, we booked our final vacant room. So I'm super excited about that as well. And so far, it's working out extremely well. So if you want to learn more about that, feel free to connect with me offline, shoot me a text, email, whatever, or jump on social, and you can hit me up on social media. I would love to have conversations with you about this. Now, again, Mary, thank you so much for being here. Thanks for taking the time. If you can please share a little bit about yourself, what you do, and why you're here with our listeners.
Absolutely. Well, first of all, thank you, Alex, for having me here. It's always a pleasure to talk and interact with you and be on one of these your events. They're always awesome and great. My name is Mary Khouri. I'm a mortgage broker, a certified mortgage advisor, and I do help first-time home buyers and investors finding the best financing strategies, especially when the original and the ordinary strategies does not work. I've been in this business for a long time, basically, and I usually like to interact with my clients, like to build relationships, and these events that you host, Alex, is one of the best to my heart. To be honest with you, I met a lot of good and great people. So today, we're gonna, as you mentioned, we're gonna be sharing some kind of information about financing strategies. And I know financing can be boring to a lot of people, so I'm gonna try to make this one as simple as possible and go over very important details that some people may know, some people they don't know.
Awesome. And, I want to add to that. I mean, as a real estate broker, real estate investor, the success of my business is all about having the right team. And, having a team in the real estate industry, it involves different people, obviously different personalities and so forth. But one of the key parts of a team is, having the right lender, right? Having the right lender that one listens to you, understands you and your needs, understands your situation, and delivers based on that, right? Because many people have their own agenda. They tend to, guide you to what is best for them. And that's unfortunate. However, that's why you have to seek and find that right lender that's a good fit for you, right? As a realtor, as an investor, I don't consider myself a perfect fit for everybody. And that's just the way it is. And I'm okay with that. It's just a matter of really finding out, who you're compatible with, the personality types who's going to deliver to what you want, and then work with them. So I'm grateful to have you as a part of our network and a part of our community, and to be able to share your knowledge, expertise with everyone else. So let's let's get this going. Let's start off with like traditional financing. Like, why do you think is the challenge, in traditional financing? Why does it work for, some people, and then it just completely doesn't work for others? What would you say about that?
Okay. One of the main reason because not everybody has A papers. When traditional financing works and works very well, because basically it can give you a good rate, good terms and everything. But unfortunately, not everybody, when they're trying to buy a house or they're trying to invest, they have the best papers or they have the best incomes on papers. So that's why this is where we actually come into a place. We have to look into the solution for these problems. We have to see exactly what's available for these people to make this transaction works. And speaking with the professional advisor, especially on the loan officer, early in the process can help you and save you a lot of time. Because if you don't structure these loans correctly from the beginning, can really, I'm sure you know that can end up to a mess later on in the process, can make you lose money, can make you lose on good deals if you don't know exactly what you're doing and which direction to go. So basically you have to know what you want, and you have to speak with the mortgage advisor that can tell you exactly which direction to go and how to structure your loan early in the beginning. Financial these like original strategies, it does not work for everybody, and you'll be surprised. Sometimes people can be making a lot of money, they still won't qualify for traditional financing, and this is where the creativity comes into place.
Got it. And then, one of the things that I notice and I share with my clients, like as a real estate broker, is, be open with your lender, right? You have to
Okay.
share the good and the bad, because,
You don't
not
know
everything's
everything.
perfect, right? And it makes your job easier, I would assume, if you know all the pieces of the puzzle and you're able to kind of put things together.
100%. The more I know about you, the more I can help you. Put it this way. And besides this, let me tell you something. People try to hand the stuff. You could never hand anything from the lender. You cannot. It's not going to work. We're going to find out about it eventually in the middle of the process. And sometimes when you find out about it really late, it turns up to a mess. So that's what I'm saying. Structuring the loan, knowing exactly what you qualify for, what you don't qualify for, what options available for you early in the process can really help you get to the goal, which is funding and closing in time. And this is very crucial. That's why you have to be very open with your financial advisor, because the more he knows, trust me, the more he can help you.
Yeah, and you said a great point, is like start on it early on.
Absolutely.
Many want to do it. Oh, I'm not ready to buy. I'm going to buy in 6 months. I'll start the process then. It doesn't work that way.
Yeah.
Again, I get it. A lot of people are reserved, are concerned that they might get sold or something like that. I totally understand that. But, again, from experience, it's always good, whether you're going to buy in a year or two, it doesn't matter. Let somebody look over your file, right? It's not
Absolutely.
going to affect your credit. It's not going to affect anything. Go through the file and figure out where, there are maybe some things that need to be corrected. Some things take more time than others. So this way, to set yourself up for success when the time comes. And to your point, hiding something like, finding out during escrow after contingencies are removed, that buyer's putting themselves at a huge risk.
Absolutely, absolutely. That's what I'm saying. The more you know up in the process, the better it is. Don't assume, don't predict. Just speak with somebody who can really set you straight from the beginning. Because there's so many options in this market right now. You'll be surprised what you qualify for and what you will not qualify for. So the more you're open, the more you understand what's around you, the more you know about loan products, it can put you in the right place.
Absolutely. Because it's not a one size fits all, right?
At
Like
all.
there's different products out there. And so some of the things, I've heard, throughout my career, creative financing, 0%, no money out of pocket, seller financing, subject to, et cetera, et cetera, et cetera. All those are true, right? You 0%, no money out of pocket. That was something that used to drive me crazy all the time. Like, how do they do it? How do they do it? How do they do it? And it's like, people, are not going to necessarily share and so forth, but it is true. It is true. It's something that, we implement in our business. It's not that hard to do. However, it's not something that the average person is going to be able to do very easily with no experience and so forth. And that's simply because it takes, strategy. It takes, again, the right team, having the right team on your side, and strategic thinking and deal structuring. Right. That's part of it. The other part of it that I've seen is also understanding there's multiple people involved in a transaction. So understanding one, the ability of, for example, your lender or others on the team, but also the seller. If you're purchasing a property, how are you going to structure a deal creatively if you don't even know the motivation of the seller, right?
Absolutely.
So a
Absolutely.
lot of times, the structuring a deal creatively is gonna be should be a win-win situation. Obviously, this way everybody leaves happy. However, it's only going to be a win-win when you do understand the needs of both parties involved. So that's, with my experience, that's been something that, creative financing is really something that I built my real estate career on and my investing on, and I just love it because one, it's challenging. Two, not everybody's capable of doing it the same way, and that makes it even more exciting. So, what would you say? Can you share with us a little bit about creative financing? I mean, I'm sure those that are on here listening now have heard of that term. Can you share your perspective on creative financing and what does that actually mean?
Creative financing is usually it's basically it's legal. We're not doing something out of the box. It's basically it's structuring the way for a purchase and or for investment different from any standard mortgage bank. That's mean what we do, what we offer, the banks cannot offer because it's very creative and it fits the client's need. It means like finding alternative solution instead of the normal one to qualify buyers or borrowers, like finding alternative strategies for income, for down payment, for equity, for cash, etc. There's so many options available in the market right now, Alex, for financial situation for borrowers. People, they don't know exactly what's available for them. So you have to educate them. We have to know exactly what's available. Creative financing is not like free money or a free pass. Basically, is structuring and finding the loan product that's going to suit your needs. It's an alternative solution to the normal ones. And this can get you to be approved easier and faster than the traditional way. So there's so many into it. Like you're talking about the down payment can be created. There is a creativity in the down payment. There is a creativity in the down payment assistant, the loan type, the bank statement, a lot of things. It's not only one thing. So it depends on your situation. We have to understand your situation, then we can act based on that. You mentioned like down payment assistant, and you're very curious about it. I mean, for example, a lot of people, they don't know exactly that they can get into a house with a zero down. People, they don't know that. Especially if you're in Los Angeles County, for example, people then fail to realize that if you make up to $205,000, you can get 3% down payment assistance. And the only thing that you need to do is just make 6 mortgage payments, and it's completely forgivable after that. You see, people, they don't know that. You can be making up to $200,000. They still can give you money. There is still money available for you to take this step. The only thing is that you need to know is find the solution, find and talk to the right person who can put you in the right direction so you can start your process.
That's awesome. Now, why do you think people don't know that? Is it you know, there like lenders are not sharing it? Is it lack of education? Some lenders don't know, or what are your thoughts? Like, what do you think contributes to that mainly? Is it compensation? This doesn't pay as much, or is it because this file is so much harder to do, or maybe a little bit of all?
I'll tell you this, everybody's looking for an easy way out. Being honest with you, these files are not easy. They're not easy, but the thing is, they're doable. And you have to find the person who's actually willing to do it for you. To me, I try to help my client as much as I can. I go this extra step. It doesn't matter because, as I told you, money is not everything in this. Building relationship, it's what matters. This a client, when he gets to this dream home and his dream comes true, it's really achievement for me. I'm happy. It doesn't matter about money. It's not only the only thing, because as a lender, you should be giving like an equal lending opportunity to everyone. So you should really have like a creativity and have so many loan options. You're not going to be stuck with one only because you don't want anywhere this client to go to somewhere else, because you never know. He might refer to family. So it's a relationship. It depends on what you're looking for. A lot of people, which, as you said, I see that they're looking for the easy way out, but also people, they don't ask, they don't educate themselves, they estimate, they do not go digging for information. So you have to do your due diligence. Like coming to a community like this, anybody will come to me and tell me, you know what, I make $200,000, I'm newly graduate, I do not have down payment. I'll tell them, good, you're a great fit for me, I'll do this loan for you. But I said, it depends on the person around you and what he's willing to do. So, but you have to do your homework at the same time. It's not only everybody else.
Yeah, and part of it, from real estate side, a realtor side is, I do notice, some of my buyer situation are difficult, right? And
Yes,
it is what it is. And that to me attracts me even more. And I've had clients come to me because other agents do not want to work with them or do not know how to work with them because the situation is difficult.
absolutely.
Personally, the best and the most solid relationships that I've built with clients and the referrals that have come in are from clients that were a difficult situation because I took them on and I took them on, full-heartedly. And like you said, not everything's going to be successful. However, when you do your best and you get them to where they want to be, that truly is satisfying, right?
Absolutely. It's
That
an
is truly
achievement.
satisfying. Yeah.
It's an achievement. That's what I'm saying. Also, we get a lot of denied files. They don't work with one lender, they can work with another lender because the other lender is sometimes willing to take the extra step, dig in more into the files, see alternative solution. And besides, it's not all loan officers or brokers, they offer all the same products. There's so many loan options in the market that you'll be surprised. There's almost fit for every single thing. And if there is no fit, you just have to direct this client to the right direction. Okay, do this, do that. Try to get somebody with you on the loan, save money, get money from here. There are so many ways. You have to be creative. It's not only black and white and A papers, because honestly, if you're going to be looking at for A papers, the clients, I mean, forget it. Sometimes, like, I don't know what to say, but it's not always like this. It's
Hmm.
impossible.
Yeah. More competition, it's not going to be that easy.
Nope.
Um, now, I want to share a little bit from my experience. Like for me, every single transaction, whether it's for my investment group or for a client, I always want to, think about it, think outside the box, think strategically, see different ways of how we can structure the deal, negotiate, and so forth and so on. So every deal, it gets boring if you don't, for me, if I don't do that. Now, one of my first property that I purchased, May 2000, it was purely creative financing. So just to kind of give a little a context, an example of creative financing. As you mentioned, it is legal. Obviously, it's fully legal. There's other ways people can do whatever they do. That's up to them. But we're talking about, the legitimate way of doing things. So the way I purchased a property, let's just say under 21 years old. Okay, I don't want to age myself right now. So I purchased a property. It's a commercial property with an office space on it for a business that I was starting at the time. And honestly, I didn't have money to my name. I was married young, going to school, trying to build a business. And with the help of friends and family and a good mentorship, I was able to find a property that, found a seller that had a distressed situation that needed to sell the property. The property was paid off. So we structured a deal in a way where, the majority of it, or a little bit over half of it, was seller financing, and then I was able to raise the rest of the money to purchase the property. So one, I didn't have money to my name. So when you don't have money, zero down payment is the only option. Let me tell you. So that I had no choice, right? So I was like, how am I going to even do this and that? I was put in that situation. I figured it out. It worked out. So not only that it was creative financing, but also that's a perfect example of no money down, no money out of pocket, and so forth. So that is, one of the ways that's the way I started. And again, it's something I enjoy doing both for myself and for others.
Absolutely.
Now, let's jump into, first-time home buyers. Again, this calls for, creative ways of strategic financing, both for buyers and investors.
Okay.
So regarding first-time home buyers, because usually those are more delicate situation to help them out. It's their first time. There's a lot of anxiety, a lot of fear, and rightfully so. What financing options do you feel that they're not really told about? I know you briefly touched on that, but can you dive a little deeper into that?
Sure, sure. Basically, first-time home buyers, Alex, especially if it's a primary residence, is they have so many options available for them, and honestly, it's the best options because they get the best rate, they get the best term, they can get with a lower down payment. I honestly, I talk to a lot of people that don't even know that they can get in with less than 20% down. They have no idea. They think they only need a 20% down to get into any property. For example, you have five type of loans that you can get in with less than 20% down. You can buy with FHA loan, 3.5%. You can buy with conventional loan with 5% down. If you are a veteran, you can get in with 0%. If you're USDA loan based on the geographic area, you can also get in with 0%. They don't know exactly what's available for them, but there is so many options. So we have to speak with them. We have to educate them because conventional and agency loans, sometimes also you can miss a lot of things if you don't know how to structure it correctly from the beginning. You have because the guidelines are kind of more strict, and we have to follow certain guidelines. But they're actually easy to make. There is so many financial available for them. They can get the best rates. These people actually they can buy as a primary and also they can buy as an investors at the same time. So it depends on how the loans is structured and what do they want to take advantage of. One of the things also that I face all the time is they don't know, they're scared. They only predict that they can qualify. They don't know what is available for them. And this can be really like it's kind of fear to a lot of them. They don't know. But the thing is, once these people, they know what's available for them, it will be easier for them to take this first step. That's all what I see through my career. Because sometimes you feel like the woman wants to buy, the man doesn't want to buy. Some of them are scared. Some of them makes money, something like this. But once you simplify it, because at the end of the day, they're going to be paying rent all their life. So for example, you're paying interest all your life. If your mortgage payment is a little bit higher than your rent, you better invest in your primary residence, because on the long run, you're going to be paying mortgage less than the rent. So it depends on what they're looking for. You have to structure it correctly. There's so many options available for them.
Yeah, it's true. Like how it's unfortunate how many people have that perception of like I need 20% or I need 25% that they feel is the standard and so forth, and it holds them back from buying, right? They just basically write off the idea of buying a house. Yes, it's the American dream, but they feel it's not possible.
No,
So the reason for these communities, the reason for this call and all the calls we get is to, again, to help you figure out what is possible for you. And the obstacle is the way. So it's like figuring out what the challenges are, and everybody's situation is different. And there are people I know someone on this call right now, and there are others out there that actually do things called gap funding, right? Like they will help you finance the actual down payment.
yes,
Traditionally, that's more going to be on the investment side. And yes, some of these loans are going to be a little bit pricier than others. However, it's available, it's out there. But to figure out what you need, what is going to be the solution for you, is you gotta, talk to someone like Mary, or a real estate consultant to figure that out. So that
Absolutely.
that is very, very cool. So you touched on that 3% assistance, right? The three
Yeah.
percent down payment assistance. Can
Yes.
you um, can you share a little bit about that? Is that a specific zip code? What does that require?
Okay. This is basically, these are like government programs available for people in California specifically. And what I like about them is, being able for you to buy a house in California, you need to have at least more than 150,000 right now. That's the minimum if you can get in something. We all know that with your life expense, with everything, you need at least between 150 to 200,000 able for you to get to 750 or $800,000 home. What they're doing right now, usually the traditional or the old down payment assistance program, they tell you you have to make 80% income from the average income of the area, which is very low. So in reality, you have to make like almost like $80,000. But this $80,000 does not buy you a house, even though if you qualify for it. You see the problem here with the down
Yeah.
payment assistance? So right now we have an option for a conventional loan. Let's say if you live in Los Angeles County. Each county has a different income limits, but they're
Hmm.
very high limits in California. I'll tell you this right now. So, for example, in California, Los Angeles, the limits are 205,000. If you make up to $205,000, you can get 3% down payment assistance and able for you to buy your first home. This is completely forgivable. They forget everything about it, forgivable if you make your first six payment on the house. That's it. You get in 3% down, you make your six payment, that's it. They don't even ask you about it if you sell the house after.
Wow.
This is
Okay.
very good. Another thing, they can give you another silent on the house that you don't have to pay any interest. It's there just for you to help you with the closing costs. So there is a lot of money available for people that they don't know how to touch and how to get basically. And honestly, I find this very awesome because there is a lot of people who are like recently graduate who can really qualify with their degree. They don't have even to have history. But the thing is, they need the down payment because having a down payment sometimes is a huge problem for a lot of people. So if
Hmm.
we can educate them and tell them exactly, you have this option, that means there is a money available for you. After 6 months, this money is for you. You can refinance, put more money, do something, but you have an option to get in with zero down. And it's not a joke only, you have to pay it back. No, it's for you. It's over there. You just have to take it.
That's very, very cool. So those are some zero down payment options.
Yes, that's
Uh,
one of them.
Moving to, the self-employed, obviously business owners, their taxes are different. Things can get complicated, especially depending on the type of business that you do. And it could affect their ability to get financing,
Absolutely.
or easily just makes it a little bit complicated. So, how do bank statement loans help 1099 buyers or self-employed?
Okay. Honestly, if let's put it this way, if we haven't had these bank statement loans, none of people in California would qualify because they're all of them entrepreneurs and they're business owners and they get paid like 1099. Honestly, I've seen so many tax returns on my desk, like businesses makes millions of dollars. I swear to God. And when I look at the bottom line, the qualifying income hardly can get them $200,000 house. It's not a joke. This is what I see all day long. But the thing is, because when we're going to look at the traditional way to qualify business owners, Alice, we're looking at the net procedure from their taxes. We're looking at the Schedule C from their taxes, the K1. We have to average 2 years' income. It's complicated. These people, they end up writing off everything on their taxes to the point that we have no income at the end for us to work with for a loan. That's how it is. So when these bank statements actually came in, they were really, really game changer because we look at basically 12 months bank statements. Okay, we have to average this and we give you an income. We look at how much you're actually getting in. We do not care how much you're paying for the business as far as liability, what is the business is losing, how much you're spending, just looking how much you're getting into this business every month. deposits only. And this is going to be very powerful because this will give you a huge income to qualify with. As far as looking at your bottom line after spending everything, you'll get no income. Here, we're just looking at your deposit. If you're the business owner, we make our equation. We look at the expense ratio. Boom, you're qualified.
There you have it. That's it. Boom.
Yeah, I mean, I'm telling you. Well, it's a great option, honestly, for a
For
lot of
sure.
business owners. This is the best option right now.
Yeah. Herman has a question about, I believe, about the what you mentioned earlier about the down payment assistance
Uh-huh.
program. Correct me, Herman, if that's not the case, but he's asking for the name of the program.
It's a CalHAFA, it's California CalHAFA,
Okay.
one of the programs that they're offering.
Perfect, perfect, perfect. Now, some people may not necessarily qualify on their own, whether income, credit, whatever the case may be, and they
Uh-huh.
have to bring in people, the term co-signer, co-borrower,
Yes.
whatever you want to call it. And, some may be those that are not going to live with them. So it's a non-occupying co-borrower. So can you share a little bit about that? How can somebody utilize a non-occupying co-borrower to qualify, and how does that affect each party?
Okay. Basically, the co-borrower, if you are easy and simple, if you're not qualifying for this loan, you're bringing somebody else with you. However, you have to know exactly which loan type you're using because some of the loan will authorize non-occupant co-borrowers. Some loans will not authorize. So we have to know the situation exactly to get you into the correct loan type. Basically, these people, they can help you with the loan. We're going to be using their income. We're going to be using their debt. This is to strengthen your profile and your file so we can give you a higher income and offset some of your debt ratio. This is just to help a qualified borrower. Basically, these people, they're going to be with you on the title. They're going to be legally responsible with you on the paper. If you default, basically it's going to be shown on the report. So they're equivalent like you on the title and every single thing. The good thing about it here is basically it's helping you to get into the game. If you have a family member who can actually co-sign for you or go with you as a co-borrower so you can buy your first home, it's very powerful actually to help you get in. And honestly, every single file I come to my desk and it denies, I ask the guy, do you have anybody who can actually co-sign for you? Sometimes they say, oh, it's hard and difficult, and they keep digging and they find somebody from the family or sometimes a friend who's willing to help them. So it's doable, but it depends on your relationship with these people because they're going to be financially responsible of you, like you. They're going to sign on the note, they're going to sign on the trust deed, everything just like you specifically. So it's good for you to find a co-borrower if you cannot qualify by yourself because it's really an option and it's a great option until you put your feet into the game, you fix your income and everything, then we can refinance, take them out. Or the only other option is to get them out is to resell the house. But it's really powerful to get you to buy your house, basically.
Now, in a situation of a non-occupying co-borrower, let's say I have someone that helped me out, right? And
Uh-huh.
I'm making the payments, and I've made the payments for over a year and so forth. And how, does that affect that co-borrower in any way, in a sense of like being able to buy their own property, being able to buy their first time? If they don't own a property, if they're a first-time home buyer, do they get disqualified from those benefits, or does it
Okay.
affect their DTI, their debt to income ratio?
Okay, if they actually they're their first time home borrower, if they've never bought a house, it will affect them because they cannot be on title of somebody else. So they have to be first time home borrowers by themselves. As far as their debt, there is a way that we can do it, and we tell the client what to do to structure it right. So once we do a loan for that co-borrower who signed for this guy, we can exclude this income from the equation so he won't be affected. There is a way that we can actually make it works, and it's very doable, but it has to be structured the right way. And we have to tell him what to do in case on the long run he wants to buy a house, that debt won't affect him.
Got it. Okay. So as long as they take the
There is
right
a way for
steps.
it. Yes.
Perfect. So again, continuing with first-time home buyers, obviously this is about first-time home. Oh, did you need to say something, Mary?
No, I'm okay.
Oh, first-time home buyers and investors. And you and I, both agree that, you can be a first-time home buyer and an investor. Can you talk a little bit about how that is possible? Like, how can someone buy their home, but also still be investing in that home and still generate, for example, rental income while living in that home and offsetting their mortgage or their previous rent and so forth?
Okay, this is very great question and very powerful, because when you are buying your first home, Alex, this is like you are really investor already. You don't know it. People don't realize this. So they buy their first home and later on they realize, oh, okay, I already have an asset. I already can do something. I can build on something. So they're starting as an investor without them realizing. Buying your first house, you are already an investor. But if you want to structure it the correct way, you should basically take advantage of these financial strategies that helps the first-time home buyer, and you can build on that as an investor. For example, if you want to buy a prop, let's say you're starting with buying your property, okay? You take advantage of the 3.5% down payment for FHA, correct? You get in with the minimum amount possible required by you. You keep the money in your pocket for something else. Later on, you decide you want to put an ADU on this property, okay, on the back. What did you do now? You're an investor. You did add on to your property. This ADU is going to be a cash flow for you in the future. You're going to be offsetting your mortgage. You're thinking about the long financial goal. So basically, even though you are a first-time home buyer, you already turned into an investor, but in the right way. You have to structure it correctly and know exactly what's your long-term goal, because this house really, really can be your net and security for retirement. It's not only you are buying a house to live in. There is so many ways you can play with this to make it your biggest and best financial investment in your life. To me, investors, they put the least money possible to make the most money possible. And you have to think this way. So if you structure it correctly, you structure your loan correctly from the beginning, you can really, really benefit on the long run.
Yeah, well said. Yeah,
Yep.
there are a number of clients that, we're working with and we've worked with that, are, applying such strategies, right? They're first-time home
Absolutely.
buyers. I have one, a single person bought a house, built the ADU, moved into the ADU, rented the house. Now her income, the rental income that she's generating is covering the rent, but also, the property value has increased. So she got appreciation. She's getting I don't want to say that much cash flow because it is in LA. However, it is covering the mortgage. So she's living rent free, and somebody's paying off her mortgage, and she increased the value of the property. And not in this particular example, but in another example where this happened, the buyer added value to the property, they generated rental income, and then
Yes.
they go back out and refinance it, like again, the BRRRR strategy, and then the goal is again, so a lot of people say you can go listen to Bigger Pockets, YouTube, and all that stuff. They say, the bird doesn't work in California or LA, it just works out of state and so forth. I'll be the first one to tell you that's complete BS, okay? Because I do it regularly, I do it for myself and for others. And it's not easy, it's not hard. You just have to again structure the deal, do your numbers correctly, underwrite the deal on the buy side, on the acquisition correctly, and you'll be fine. But a number of examples in LA where we've done that, and then we recoup when we refinance, we recoup that money back that we injected into the property, whether it's the down payment or the rehab cost.
Yes.
We recover that, and our goal is to be, again, no money out of pocket into the property. And that, in my opinion, is called infinite return, right? Now,
Absolutely.
to top it all off, to make it even sweeter, is when you actually when you refinance and you build enough value in the property where the appreciation exceeds the LTV that the lender is able to give you, and you end up getting more
More
than what you
money.
originally injected in the property, right?
Basically, yes. And there is also another opportunity here for people, like when they can buy like 2 to 4 units with a 3.5 down, with 5% down, with zero down. People, they don't know that. So if you can get into these properties and live in one and rent the others, you're already making money. It's like you already have a long-term like financial plan. You're leveraging lower occupied financing strategies to get lower rates, lower payment, flexible terms, and you can build this net worth and real estate portfolio. So there's so many options here available for you. But this is honestly, I see this house hack is one of the best strategies basically for people to add value and to get money for the long run, as long as they they know how to structure it and structure it correctly from the beginning.
Yeah, I mean
Yes.
it's a no-brainer. Now you mentioned like getting a 2 unit, 3 unit, 4 unit. It's easy, immediate, entry into, again, buying your home, but also
Yes.
generating rental income because the units are there. Or the other example, like I shared, you can add value, create extra space, and so forth, and build. Now, talking about the up to 4 unit, like those that are listening are going to wonder why, oh, that's multifamily. But can you share why up to 4 units, it's still considered like buying a single family home, right?
It's all the agency guidelines. We have nothing to do with it. They only like with 1 to 4 units. This is what they like to finance most with these type of loans. It's the guidelines that we follow. Basically, it's like any other FHA loan. If you have a 3.5%, you can buy 1 to 4 units. You live in one and you rent the other. Right away, it's a money maker for you. And what's good about, and this is also applied to conventional, you can get in with 5%, the same like VA and USDA. If you find these properties and you can get into them, this is great. But the thing is here, these, when you are getting into them also, you are adding value for your future. And this rental money is going to be money income to you. That's going to help you in the long run to get a loan, to refinance. You already have additional income as a landlord. Also, you have benefit to put in your taxes because you can write off a whole bunch of things as a landlord. So the 1 to 4 units is exactly what we follow as a guidelines. We have no control over it, but it's really, really great options if we can find a right property for you.
Very cool, very cool, very cool.
Yes.
Now, what options are there for, if someone is looking for a property that needs, the renovation, needs
Okay.
fixing up? Can you talk a little bit about that?
Okay. If you're looking for fix and upper, basically, the only thing here, Alex, we fix and uppers is not going to appraise. We all know that. That's why we have to look at the creative financing, which is in this case is a hard money loan. Basically, you get into this hard money loan. It's a temporary loan, 6 months, 24 months maximum. You get into it. At least you have an option to fix this property, rehab it, make it livable so you can rent it. Then you can refinance it. You pull your money back, pay them, get rid of this hard money loan. The fix and flip loans usually are short-term loans, interest only, they're expensive. But honestly, as an investor, you should not even think about the rate or whatever they're giving you as long as you can put your foot at the game. Because somebody's giving you money to build wealth, you should take it. This is how I look at it. It should not be any other distraction. So these fix and flip loans usually are short-term, hard money loans. The reason is property is not going to appraise. Nobody's going to give you a long-term loan if the property is not going to appraise.
And the property not going to appraise, you're saying is because of most likely like the
Fix and upper.
condition,
Yeah,
right? Because of
fix
the
and upper.
condition, it's
Yeah.
broken window, floor, gutted, this and that. Like for example, right now there's a property that we're closing on early next week. We're supposed to close on yesterday. It's completely to the studs, right?
Yes.
There is no conventional loan that's going to qualify that.
Cover it.
There's no
No.
way, right? Appraiser looks at it, they're going to walk out right away. It's funny. I had that happen before. He's like, what am I doing here? And then he rejected the appraisal, and then until they had to send somebody else. So, yeah, situations like that, you can't just walk away from it. It's obviously a property, it's a good deal, then you buy. But yeah, hard money loan is
The
is
option.
one of the greatest options. Now, again, another good point you point out is that it is expensive,
Mhm.
it's short term, and for those reasons, many investors shy away from it, which is unfortunate because, like you mentioned, okay, we're not here to just throw money away, but when you're an
No.
investor, you're a business owner, everything comes with a cost, right? You have to
Absolutely.
see your ROI, you do your numbers, you underwrite the deal. If the deal makes sense, you do it, right? You don't
Absolutely.
get caught up in, oh, this person's making this much and this. It is what it
No.
is. Everybody's gonna, in it to win and to make money, but don't let that discourage you. There are ways, and just do your numbers correctly.
Absolutely. And also when you're buying this fix and upper, you're thinking of the long run because once you this guy's gonna give you money to fix it. Once you fix it, your money is gonna double. So you should think of the long run, not only right now. So who cares? I'm paying like interest rate a little bit high. As long as I can get this money to fix it, that should be the bottom line for me because this is my goal. So everybody thinks differently, but I don't think interest rate or the type of loan should stop you as long as you can get your project done.
Yeah, Because I mean, even when you get into more expensive, like private money loans, they're going to
Yes,
be expensive as well. However,
they
it's an
are.
option.
They
It's an
are.
option. You know, the private money lender needs to, have a security and needs to be able to make money, and then gives you an opportunity to have funds to purchase properties that you wouldn't have otherwise. So,
Absolutely. I want to mention something here because I
yeah.
know most of the people, they know that there is only hard money lending on investment properties, but really also we can get hard money loans on a primary residence. So
Okay.
we have an options for that, but of course it has certain restrictions. So if you're thinking of buying a property to fix it yourself, but you have a money to put as a down payment, this require like almost 30%, and you have a little bit money to fix it somehow, you can get into, we have lenders that we can actually, investor can put in money for that project for you. So there is an options for that as well.
Very cool. That's good to know.
Yep.
So, as we come to the end of our conversation, I can't believe time went by so fast.
I know.
I do want to touch on something that, some of you may have heard of or heard, and then, hear of a lot is the DSCR loan. Can you touch on that, please? Like, let us know what is a DSCR loan and what is it used for, and how do investors use that to scale their portfolio?
Okay. I'm going to ask you a question. I'm going to start with the question.
Mhm.
Okay, with your income or with anybody's income here, how many units or properties can you buy?
I don't use my income to buy, for
Anybody.
example, right?
Yeah. I'm talking in general. If I'm going to look at anybody's income, how many properties he can buy? Probably hardly the one he's living in, correct? But
Especially here in California, yeah.
yes, the DSCRs are very powerful. Why? Because you can buy 20 properties without looking at your income. That's what makes them so powerful. Basically, the meaning of it is the debt service coverage ratio loan, whatever that is. It's great for investors and for first-time home buyers who are trying to invest in the real estate. It works on both. Basically, the bottom line of it, if the rental amount covers my mortgage payment, I'm good to go. I qualify you. So it's a ratio. It's a kind of complicated ratio. I mean, we can go a little bit less than the rental amount. You increase the down payment. It's like we play with the numbers. It's only number and ratio. But what makes it so powerful is can help you acquire as many as the properties without me looking at your liabilities. You can be completely full of debt. It doesn't matter. We look at the property and the property is going to qualify you. The appraisal, rental report is going to qualify you. It's easy and simple. You can acquire as many as you can for properties as if they're rented out, and you can purchase as many as you want. And if you have property that's rented out and completely paid off, and you're not benefiting from the money in it, you should think again because there is a way for you to refinance it, which is the DSCR loan, and we don't need your income to qualify for that. Only the rental income that's coming from that property is going to qualify for this loan. It's very powerful. Honestly, when it came like what, 3, 4 years ago, the DSCR is not longer than this. It's been really a game changer because I believe this is what they kept market standing for a while because all these investors, they found a way to do it, with these DSCR loans, and they end up buying with so many states because we can do it in 48 states. So it's really, really, really a great product available for every single investor.
It truly is. And
Yes.
it almost sounds like too good to be true, but it's awesome.
I
That's the way,
know.
we do it. So an example, for example, you have a single family home, you rent it out, the lender's going to do the ratios. Now, let's be
Yes.
honest, for the most part in LA, in the LA area, based on
Uh-huh.
the purchase price and then the rental, the market rent, that ratio is going to be very off, right? Now,
Absolutely.
how do you do that? In LA, unlike other states, is you have to add value. You have to generate multiple streams of income from a particular property. So, for example, you have a single family home, you create an ADU, you create a junior ADU, you create multiple streams of income, or you utilize the strategy like Senate Bill 9, SB 9 with a lot split. You build another property, a duplex or a separate home, and then if the land allows it, you build ADUs for those particular properties. So you can have six, depending on the city, like San Diego, it's a lot more than that. However, those are multiple streams of income. You combine them together, and then you do that ratio becomes a lot more attractive for the lender and then for you as the owner, and then get the financing.
Absolutely. We also do in Los Angeles. I've done so many of them, but I mean, the property has to have a lot of equity bought long time ago. The ratio that I see works in California, honestly, between 70 to 40% loan to value.
Mm.
However, we still can do DSCR loans with no ratio. What's good about DSCR, we can do it also for international investors. So basically, if somebody is coming from all over the country, he should not have, he doesn't have visa, he doesn't have papers, as long as he put like 30% down of the property, he can acquire rental property in the US. So it's kind of really, really great. And like there is so many divisions of that product, you know, but you have to see the best one for every single situation.
Very, very, very cool. Yeah, I didn't know that about,
Yes.
international buyers. They can do
I
that.
close a lot in Dubai, in Kuwait. I told you about this before. People put like what 30% down and they buy properties, you know. The equation did not work very well in California, you know. It works in other states because they're cheaper, but it's a
Mhm.
way for people to buy a property. And that's what they're doing right now.
Very, very cool.
Yes.
Well, this is it, guys. If anybody has a question, a burning question, please drop that in the chat below. Mary, I truly, truly appreciate, the contribution you do to our community. I appreciate your consistency, always showing up, always being there, ready to help and serve anyone that needs it. We truly, truly appreciate it. And share with us how can somebody reach out to you if they want to connect with you, if they have any further questions. What is the best way for them to reach you? And we'll also, this is obviously recorded. It's going to be on our YouTube channel. If you want a copy of it, just mention copy in the chat below. And we'll send that over to you when it's ready, and we'll have that information that Mary's going to share in there as well. So, what's the best way to reach you?
I mean, you can call me, you can text me. I can arrange a phone call with you if you want. I can go over strategies and I can help you structure anything you want. I'm going to leave my phone number in the chat, you know, in case somebody would like to reach me here. And Alex, thank you very much for the opportunity. It's always a pleasure talking to you and having this conversation. It was very actually awesome. And hopefully we were able to deliver some good information to people. And that's our goal basically for the community.
Very good information. It's a ton of knowledge in just this under an hour. So I truly appreciate it. Thank you all
Sure.
for being here. Hope we can see you at our next online event next Thursday. Otherwise, in Studio City on, I believe it's the 27th. You guys have an awesome day and take care.